How to build wealth during a high inflation period.
It's Brian Preston, the money guy.
Brian, I am excited to talk about this today because I feel like one of the questions we're getting all the time, being financial advisors, doing this for a living, having this be part of our day job is, man, what do I do? I've heard about inflation. I've seen inflation. I'm literally living inflation right now. How do I think about it? How do I approach it? How do I keep myself protected? I think a lot of people are asking that question right now.
Well, I like to say we were early to the game on this, is that we've done some content on inflation. I think, and I'll cover it in a second, when we did our last show on inflation, it was about a year ago, inflation was still listed at about 2.6%.
Sure.
If you tied it back to CPI. We are over 7%. That's right. And as I've shared with you guys, the CPI is adjusted in some ways that in a lot of other aspects of your life, it's much, much higher than that stated 7%. And this guy, it impacts you tremendously, from what you're buying at the grocery store to the cars you buy, the houses. So we wanted to kind of give you, how do you navigate this? And then I liked how we kind of adjusted this show, Bo, where we actually want to go a deeper dive on how you make the decision making so you don't get caught up in what's temporary, what's things you just need to alter your mindset so you're doing the right things for your wealth building.
So maybe you just tripped across us, you just stumbled onto this. If that's the case, make sure you go check out our website. Go to moneyguy.com. We have tons of things out there, tons of resources, tons of things you can take advantage of. But perhaps you're asking the question, hey, inflation, I'm not familiar with that. What is that? Well, quite simply, inflation is simply the rate at which the price of goods and services rise over a stated period of time. So something costs X dollars today, and that service or that good will cost X plus percent tomorrow or next year or 10 years from now. It's just a general increase in prices through time.
Well, I think it's what's amazing to me about inflation is how it impacts your thought of what things cost. Meaning that I think if we'd have all looked back 2 years ago, our brain's been expanded to accept the new prices exactly right. In some ways. So that's why it's good to go back and review so you can see through the cloud of this, all the updates that are going on around us. I had Daniel, we kind of talked to him and said, hey, give us some slides on the history of inflation, because a lot of people right now, this is your first time of really getting something that goes outside the bounds of that 2%, 3%, 4% a year.
Yeah, it's interesting. You were saying, Brian, I think for a lot of our audience, a lot of the folks that are living in this world right now, consuming this data, have potentially never lived through like a significant inflationary environment. I mean, even if you look at the last decade, right, the last 10 years, you can see that inflation hasn't been too crazy, right? It's been sort of normalized until we get into the 2021, 2022 type era. And that's exactly what you said, where it popped up over 7%.
Yeah, I mean, if you just look how far we've come. We did a show March of 2021. Inflation was right there in line. I mean, right under 3%. What could go wrong? Yep. And then here we are. We have this hockey stick where this thing shot straight up. And we're kind of, what does this do to your wallet? What does this do to your investments? What does this do to where you live and how you live your life? We're going to jump into that.
Now, and so one of the things we know is that history often has a way of repeating itself. So one of the questions that if this is your first time experiencing inflation, or maybe you've experienced it before, but you're thinking, oh, is this a new paradigm? Is this a new normal? Is this something we've not seen before? We thought it'd be interesting to kind of rewind and look at what's inflation look like in this country over a longer time period than just 10 years. So if you zoom all the way back to 1914 until through 2021, inflation has been a wild ride in terms of what we've seen as a country, as consumers, over the last 100+ years or so.
I think, looking at this from a broad macro sense, you can tell that world wars obviously create scarcity. They drive up inflation. So that makes sense in the past, in the early 1900s and the 1940s, what was going on there. 70s, I mean, look, you weren't around, but I was. I kind of remember some of those crazy things. That's why we even make jokes around the house when we go to a Costco line of it. Man, it feels like the Carter administration's back in, because that was one of those periods that we all lived through. But also notice, if you look at the chart from a historical standpoint, bonds with interest rates and what you could get off savings, they hit a high, because inflation, typically the way you battle is you raise interest rates much higher in the early 80s. And we've had this, 30 plus year bull market for the bonds, because when you have a slow dripping interest rate that keeps going down, obviously bond investors do very well during that period. It's kind of a different period when all of a sudden here it is, the hockey stick that's popping up, because we're in an inflationary period right now.
I think what's interesting is we know that the law of large numbers tends to be a thing, right? Like things tend to revert to their mean. And so if we look at this 100+ year period, inflation has averaged about 3.2%, per year. But if we don't think about per year, we think about like business cycles or economic cycles. It's interesting looking at the annual inflation by decades, from the 20s of the 1920s all the way until the 2020s. We have not seen a decade of inflation, or an extended period of inflation above the long-term average really since the 80s, right? So this is kind of something new we've not really seen in the last 30 or 40 years. So imagine it probably means there are some things we ought to be thinking about differently than maybe we have thought about them for the last 30 or 40 years.
Yeah, I think it's interesting. We're only in year 2022. So to say we're at 4.1%, that's a very small snapshot. That shows just how much that pop we've had just in the last few months has already impacted this decade. So it looks like we're definitely on track for the 2020s to be much higher than normal. That's a Captain Obvious statement, obviously. But it's one of those things where let's now pivot and let's talk about how do you protect yourself from this, because I think it is important to kind of figure out, are there some investments, are there places you can put your money that will actually let your dollars, go a little bit further, because that is the concern. You're worried about if you're just sitting on cash, if a jar of baby food is $1, and then you fast forward, I don't know. You know what?
I know exactly why
we had a baby shower yesterday here in the office, so that's
how we know it's
front
$1.
And center. So I'm off script here, but it is one of those things. If all of a sudden, now a jar of baby food was $3, you can see how the purchasing power of your single dollar that's in your pocket has diminished greatly. So you have to worry about that. How do you protect yourself so that you're not losing on the purchasing power of the assets you have, but also getting some appreciation that's hopefully keeping pace with what's going on with the loss of purchasing power?
Yeah, one of the financial products that we've talked about recently that's been super sort of a hot topic is I-bonds, right? I-bonds came around, they were first issued in 1998, and they were designed to keep up with inflation. You were supposed to get a fixed rate of interest plus an adjustment for inflation to help combat some of that. And so as we sit here today, hearing about what I-bonds are returning, something like 7%, we immediately start thinking, oh man, are these things that I should be taking advantage of? Is this, in fact, the best way to combat inflation? And Daniel pulled this chart for us from 1999 through 2021. It shows what the composite I-bond rate was, so the fixed rate of interest plus the inflation adjustment, relative to what inflation was. And as me and you were talking about this pre-show, Brian, you had some sort of, it was sort of a unique thing you noticed. You're like, okay, man, that doesn't look the same now as it maybe once did.
Well, if you go to the Treasury website, now look, government moves a little slower, but they'd stated their original intent with these I-bonds was it was going to protect you from inflation, plus get you a little return on top. And that seemed to be the narrative as well as what the practice was. 98 is when these things came on the scene. So you see all the way through, and then about something happened, 2008, it's like we had the big financial crisis, and they're like, that whole extra on top of inflation?
We're not doing that anymore.
Let's hope they forget that part of it, because you can quickly see that I-bonds have not tried to beat inflation. They basically are just inflation.
Keeping up with inflation.
If you see the chart, it does definitely show that these things are right in line. There's not really much of a premium that is paid, and that's something to keep an eye on. We did a show on this, Bo, not too long ago, that if you want to go deeper into it, I will tell you off the cuff, though, I like I-bonds, but there are some huge limitations in the fact that you have to buy them directly through the Treasury. You can only do so much a year. I believe it's $10,000 per individual, and then $5,000 through a tax return on top of it if you want to get a refund from that. So it might not be perfect just because it's not something you can slap into your IRA or your brokerage account. You have to actually go buy this thing directly from the government. But go check out our deep dive on this, and it will definitely give you all the data you need to know.
So if I-bonds aren't the solution, or they're not maybe the large solution that you need, we want to talk about some things that realistically can help protect you from inflation. And I would say, Brian, this is probably one of our favorites. This is the one that we talk about the most, and this is the one I think that probably has the highest likelihood to keep people protected over the long term when it comes to fighting inflation. And that's stocks, investing in companies and businesses.
Yeah, I mean, we could have titled this equities too, because we're using, a lot of times mutual funds and ETFs because they're investing in these things. And this is one when I'm watching Twitter feeds and other things, I kind of pull my hair out a little bit in the fact that, because people are always talking about, of course, real estate. They're always talking about, truthfully, you don't even hear about I-bonds that much.
No,
we kind of brought that up. But then you hear about maybe Bitcoin or gold and other things like that. And I'm always like, stocks, talk about the equities, talk about investing in companies, because guess what companies can do in inflationary periods? They can raise their prices because that's what happens. You get scarcity. They're allowed to increase prices. You can participate in that. So let's make sure you understand the details. So a lot of you are like, that is true. I haven't heard a lot about this. Can you backtest this? Can you go back in time and show us what has happened in prior higher inflationary periods? And we had Daniel pull that data. If you go look at the late 70s, early 80s, you can see 1978 inflation was 7.5%. Now look, this is, you're gonna be like, well, why is he starting off with 6.41? But this actually makes my point. When inflation comes on the scene, it is not uncommon to have short-term volatility, because it does cause some issues where, companies are trying to figure out, do we pass this on to customers? Do we absorb it and it hurts our profit margins? There is a period of uncertainty, but eventually, once we realize we are in an inflationary period, the company says, you know what? We got to pass it on. And you see the price increases go out there to the customers. So let's continue this exercise. 1979, inflation was unbelievably 11.35%. The S&P 500 made 18.69%. 1980, 13.5% for inflation. The market made 32.76. 1981, 10.32% inflation. Market lost 5%. But look, when you're making 18 and you're making 33, you can give back 5 because there is volatility. You don't get this all free. If it was free and easy, we'd all do it. 1982, inflation starting to moderate a little bit, 6.2%. Market still made 21%. And then I closed it out with 1983 on purpose because you can see inflation is back to kind of historical norms, 3.2. Here's the good news when you do equity investing. You got to believe if you're coming through a high inflationary period when, prices are going up, everybody's freaking out about it. When you actually get your first indicators that inflation's been tamed and we're back to historical norms, what do you think people are thinking? They're like, hot diggity dog,
best of both worlds.
Because now we don't have to worry about this corrosive part where our purchasing power is going away. People are going to celebrate because guess what? Companies now, in addition, just raising their prices so they can keep it, they actually get to keep more of that profit margin because it's not like prices fall all the way back to where they were. So you see the markets actually celebrated with a 23% rate of return in 1983. Guys, investing in equities, investing in the ever-expanding economy is actually a great inflation hedge.
Now, we are not suggesting that we are anticipating 11.4, 13.5, or 10% plus inflation. Don't mishear us on that. But it is interesting to look back at the late 70s when inflation was rampant to see what the market was doing. And so the question that you may be asked is, okay, well, stocks are good during an inflationary environment, and maybe it was good in the 70s, but does that mean I just do the stock thing right now and then get away from that and stop doing that? No, not at all. If we look at the S&P 500 versus inflation from 1980, right there at the end of that high inflationary environment in the 70s, all the way through 2021, you can see that inflation has averaged about 3.3% per year. Again, right in line with that 100-plus year average. But the S&P 500 has actually made 11.6% annually. So the purchasing power of your army of dollar bills actually grew through time. Not only did it keep up with inflation, it smoked inflation over this past 41-year period.
Yeah, so that leads to, because we just gave you a lot of ammunition on why equity investing can actually be good.
Sure.
Now, look, there could be volatility, but long term, in the short term, there's volatility. Long term, this thing is a wealth building process. But a lot of you are probably right now going, what about real estate, guys? Let's talk about some real estate. So once again, I think it's interesting. We know owning a home can be valuable and be a hedge to inflation, but that's tough right now. And I want to put a kind of a pin to pause, and we'll come back to this later because that's going to be in the decision-making part of the show. I do want to talk about some of the struggles I know even our own employees are having in this crazy inflationary period.
One question I have for you, Brian, because you and I have talked about this a lot before. We just said it sort of as a given. Owning a home can be a great way to protect against inflation. A lot of our audiences probably never owned a home, never experienced that, never done that. I remember you telling me the first time that you noticed owning a home was a good inflation hedge. You were talking about your parents, right? And how much I can't remember if it was their first house or their first mortgage, and what they had versus when you went off to the University of Georgia. Do you know what I'm talking about? Yeah,
I mean, it was one of those things where my parents, we built the house that, kind of I was raised in 1978. So I'm sure they signed the contract in 1977, but we moved into it in 1978. And I'll never forget, my parents paid $60,000 for that house. So when you hear Warren Buffett talk about...
For a family of four.
Yeah, because Warren Buffett, you hear the story all the time. He bought his house that he lives in for like $35,000 in like the 60s. Well, I have the similar stories. My parents' house was, late 70s, was $60,000. Fast forward, I go to college in the early 90s, graduate college in the mid 90s, get my first apartment in Atlanta, and I was one of three guys living together. My part of the rent was $450 a month. Now, look, that sounds cheap right now. A lot of you guys are watching this going, my portion's $1,200 a month.
Inflation.
But that's, once again, a point of inflation because I'm getting older at this point. But my $450, which was a third of the $1,250 of the mortgage because I had a bigger bedroom, was my parents' mortgage was like $300. And I was like, how is it that my parents can have a house now that's worth $250,000? I'm living in this little apartment and their payment is a lot. That's what inflation does. So a lot of you guys, I know, but here's the thing. I know Team Crash, some of our employees that are trying to get on the real estate train. It's not a fair time right now, and we'll come to those points. So I'm telling you don't have to buy a house to also have inflation hedges. You can buy real estate mutual funds, real estate ETFs. You can buy REITs. There's all kind of ways you can invest. Even if it's $100 at a time, you can also be a real estate investor.
And I think one of the great things about that is it gives you the exposure to real estate and gives you the ability to invest in real estate without having to do something like go out and buy rental properties or go out and buy physical land. Again, those are things that you can do, and those are things that can be an inflation hedge, but there's some barriers to entry in terms of cost of capital. In our opinion, rental property is not a passive activity. It's a very active activity. But if you were someone out there and you just said, you know what, I like this idea of real estate. How has it done against inflation? How has it performed? Well, if you look at the FTSE Nareit All REIT Index, so this is just a global index of real estate investment trust investments. Since 1980, inflation has averaged, again, that 3.3% or so. And real estate has made about 10.3% annually. Again, not only did it keep up with inflation, but it smoked inflation. It did much better than inflation. So certainly real estate as an investment was a great hedge and a great way to combat an inflationary environment.
Yeah, I think based upon just some of the data we looked at, real estate does do well during inflationary periods. Equity investing, meaning in the financial markets, does really well. But this is just if you're an investor. But what I don't like about this, Bo, and this is something when I went back and looked at our previous content on inflation, we got to talk about how you live with inflation. How do you actually make decisions? How do you actually know what to do so that you come out on the other side of this and you don't get left holding the bag of bad decision making, or you even figured out a way to prosper through these unique times. So we wanted to kind of go into some of the key areas that are definitely impacted by inflation. And since we were just talking about real estate investing, let's talk about housing decisions while you're going through an inflationary period.
Yeah, I think this. So we have a lot of young team members here, early on in their career team members here. At Abound and the Money Guy, and they're like, man, guys, I hear you, inflation, and I want to get on this train, and I want to be a homeowner, and I want to do these things, but it's hard right now. It is like a very hard thing. So a lot of people are asking questions around, do I still do it, or do all of the old rules still apply, or are there new rules now? Because there's some unique things going on right now in the housing market.
Well, the first thing, when I'm looking at any type of moment in time, I say, why is this happening? I always want to know, just like I'm asking you to figure out your why on your financial life, I'm always going, why? It pays to be curious. What's going on right now to create this situation? And housing's kind of unique. And you're going to notice a theme here. Scarcity drives a lot of this. What do I mean when I say scarcity? First of all, there are some population changes occurring in our country right now, and where, like, I can tell you right now in Nashville, where we live right on the outskirts of Nashville and Franklin, it feels like my neighborhood has a lot of Illinois people here from Chicago. We have a lot of California. We have people coming into Tennessee, and the thing is they're coming from areas where the cost of housing was substantially higher. Yeah. So when they come from California to Tennessee, they're like, your houses look like they cost a nickel. So that's one thing. So you have influxes of population coming in, but there's also another scarcity element. Housing construction, think about new homes, especially for tract builders or production builders that are more corporate focused, not your local builder. They typically can turn a house around in about 4 months. Yep. The spread because of supply chain issues, it's taking these same builders 12 months. Yep. I've heard of 14 months. I mean, these things, they are controlling expectations because they're having supply chain. That is exasperating the situation even more. So understand the why, but this also leads to this might not be something that happens forever. Because good thing about humans is we recognize there's an opportunity, and we will catch this up. The supply chain will not always be an issue. More builders, people will decide they want to be builders. This will catch up, so you need to be careful. And we want to talk about what does that mean when you're in these unique times, and how should you do it right?
And if you are a financial mutant out there and you're hearing things like houses are getting multiple offers at way over list price, and they're waiving appraisals, and they're moving quickly, and people are stretching. Your financial mutant spidey senses should start going off a little bit, because we don't know exactly what it is. We don't know how it's going to play out, but there's something very unique going on. And so I think especially for young people or people getting into their first home, you need to be very careful right now that you understand the variables that should go into your decision of whether or not permanent housing, is a solution that is right for your circumstance.
Well, first thing, take inventory of what benefits you have that maybe a lot of people that are driving this price increase don't have. And one of them is time and flexibility. So if you're a person that lives in a community, maybe you're living in an apartment, or you already have a smaller house, but you want to upgrade because you've got a growing family, and you look at your situation, you go, look, I'm already here. Yep. It's not like I'm trying to move my family across the country. I'm right here, right now. If it takes 12 months to 14 months to build a house, I could probably do that. I can be a little more patient. Because we are seeing some strange distortions here in the Nashville area, that because we have so many people coming in that need a house yesterday, they will pay whatever. They'll bid it up. It's not uncommon to have 10, 15, 20 offers, and it's a feeding frenzy. Meanwhile, like across the street from your neighborhood, there's a brand new neighborhood being built. And yes, there's still going to be a lot of demand, but you could go in there. You could put an offer to build in there. Yes, it might take, like I said, 14 months to build it.
But you can at least get in.
But you can get in, let them build the house without you getting the feeding frenzy of everybody getting in there. Pay attention, because time and flexibility might very well be rewarded right now.
And so then after you figure out how flexible your timeline is, You need to think about your secondary timeline, not just like how long before I need to be in the house. Realistically, how long do I think I will be in this location? Is this something where I've already bought the farm and I've got the kids in school and I've got the job that's going to be the career and I'm going to be here forever? Or are you in a place in life where you don't know what next year is going to look like? You don't know what 2, 3, 4, 5 years from now might look like. Depending on which one of those appropriately describes you should very much affect your decision if you're willing to go out and make potentially the largest purchase you will make in your entire life at potentially one of the most expensive times in history to make that decision.
Exactly. The longer you can stay in an area, the better, because it's going to moderate. I always love, like, when I'll pull this back to financial investing, like in the stock market, but it has a great analogy to housing. We've done so many studies that when you look at financial market performance annually, it does look like that yo-yo.
Yeah, it's like sporadic all over.
But when you look at it 10 years, 15, 20 years, it's amazing how smooth things get. Well, the same thing happens with housing. Is also a very large financial decision making, and right now we're in the short term super volatile changes going on with price, and right now we're on the way where it's going up. So I would tell you, look, if you are only going to be in the area, the neck of the woods, the neighborhood, the community, less than 3 years, you probably need to hold on tight and not really be trying to buy a bunch of property or doing things, because you just don't know what the situation's going to look like in 3 years.
It's illiquid.
I would be careful, because it's a very illiquid investment. Now, look, right now it seems like it's the most liquid thing in the world because there's so much demand, but you have to plan for the long term, not these short-term momentum things that you could get left holding the bag. 4 to 7 years, look, okay, you can now consider buying in real estate, but I don't want you to lose your head, because Bo mentioned spidey senses earlier. It drives me crazy. I don't know what I would do in this current environment, because to tell somebody that I can't do due diligence, meaning I can't go make sure that the pipes on your air conditioner are too small for the unit so it will never heat or cool right. I can't make sure there's not water sitting under something in the basement that's going to rot through or cause problems. That would bother me, because Bo has already also shared, this is some of the biggest financial decisions you will make in your life. To take away my ability to vote with my feet because it's not a good deal, it would gnaw at me to no end. But that's the situation we're in. So that's why I would say, if you are 4 to 7 years, you can buy, but don't lose your head and get caught up in the antics and the frenzy that's going on right now.
And I would say, don't lose your head even when you've heard of other people that have made that decision and it's worked out okay for them. Because I'm hearing that all the time. Oh, well, I have this person and they built a house and they moved in, and then they recognized 3 months after they moved in that the house was up 20%. So they sold it immediately. Yeah, that may have worked for them and they may have gotten lucky and it may have been okay. I would not bet my financial future. I would not bet my army of dollar bills on that happening. Sound financial decisions are sound financial decisions when things are crazy and exciting and nuts, and when they're scary and frightening and uncomfortable. That's why you really, especially in one of these sort of euphoric housing times, you really need to check yourself and make sure you're following fundamentals.
So people are hearing me, they've heard me talk about 1 to 3 years. They've heard us just talk about the midterm 4 to 7. The 7 to 10 is going to cause even more discussion, because I do think it's interesting. I have a lot of discussions with a lot of our staff here that are in that stage where their income's going up rapidly. They know because look, if you work at Abound Wealth, you're here a lifetime. So we know you're going to be here over 10 years. And it's one of those things where you have a good career opportunity. You know you're going to be in the community. What is somebody who's got over 10 years? How do you look at this? And I always tell people that if you're in a situation where you know your income's going up rapidly, you know you're going to be in the community, this does get much harder, because in addition to price increases and things going up rapidly, we also know we're in a unique time here that interest rates are at historic lows. So I'm giving you permission to, especially if you're going to be in the area for a super long time, you really need to think about, hey, maybe this is not the ideal time to buy, but maybe because of the interest rates and some other unique things, I have to hold my nose and know that this is, I just have to do it for the long term. And we have some illustrations to help you understand why interest rates are huge when it comes to buying houses.
Yeah, I think a lot of people don't recognize how impactful that can be. Now, I'm going to put you on the spot. I have a question. I don't know if you're going to know the answer to this off the top of your head. Do you remember what the interest rate on your parents' first mortgage was?
You know, here's the thing. 1978, it was, not a crazy inflationary period, but it wasn't only until recently. So if I had to guess, it was probably around the 6% range.
Do you remember what the mortgage rate on the first mortgage that you took out was?
Oh, yeah, for sure. I mean, I bought my first house in 1998, and I thought I stole it because realized this was the period where they were trying to slow down, the economy because it was moving so fast in the 90s that we had gone to a period where interest rates on mortgages had gotten over 7.5%. So I was now on the backside because they overdid it, and so they started dropping interest rates. My first mortgage was at 6 3/4, and I was ecstatic. I thought I had just gotten away with something at 6 3/4. Now you can imagine when you have interest rates around 3. We're like, how did he even get excited? But I'm just telling you, your worldview, you'll feel a shift. But interest rates can change, and they have been much higher historically.
Yeah, my first house I bought in 2009, and I think my first mortgage was 5.75%. That's not all that long ago. That's in recent memory. But right now, that sounds crazy. Well, here's why it matters. Here's why interest rates can have a huge effect on the decision that you make. So let's assume that you follow the Money Guy metrics, and you know that when it comes to housing and housing carry cost, you don't want to spend more than 25% of your income on housing. And you've determined that number from you equates to a monthly mortgage payment, monthly housing cost of $1,500. Well, let's assume two unique interest rate environments. Let's assume in one environment, your interest rate is 2.5%, super, super low, like what we've seen recently. And then let's assume in a different environment, maybe a more what I'm going to say normalized environment, the interest rate is 6%. When you look at the mortgage that 6% interest rate will allow you to have, it's $251,000, right? So $1,500 payment, $251,000 house. With interest rates at 2.5%, that same monthly payment would allow you to take out a mortgage of $380,000.
We were talking about that in planning, Bo. That's a over 50% increase. So, and I think you said it best, is that's like going from a 2,000 square foot house to a 3,000 square foot house. And there is zero difference in your monthly carry costs because interest rates are making up the difference. Right. Guys, you can see that makes a big difference, especially if you're in that messy middle, you're raising children, you need a little extra space so you keep your sanity.
That's right.
This is super important. So it obviously impacts purchasing power. What about how the monthly payments? Because what if maybe I don't have the ability to be flexible on the size of the house. I just know in my market, the minimum cost of the house is this. What's the impact on my monthly payment with this purchase?
Or exactly what you said. You have a family and you know that you need to buy a house that's $380,000 because that's what it's going at. And you know that if interest rates are 2.5%, my monthly housing cost, my mortgage payment will be $1,500. Well, to buy that same size house with a 6% mortgage rate, instead of paying $1,500 a month, you're paying almost $800 more, and almost $2,300 a month for the exact same house, and all that changed was interest rates. And now, potentially, if $1,500 was your 25% number, now you've blown through that. So I think a lot of people right now are faced with this decision. If I do think interest rates are rising and I do want to get on this side of the home ownership equation, should I do it? How do I make that decision? I think the way that you do it is you have to go back to exactly what you said. Am I less than 3 years? Am I 4 to 7 years? Am I 7 to 10? Am I greater than 10 years? You have to figure out where you are in that timeline, as well as answer some of the variables like, okay, what do I realistically think my income trajectory is going to look like? How short is my job? How short is my family circumstance? What are the things that might change? This is a really hard time, I think, to be a first-time home buyer.
Yeah, and that's why you have to really take into account all the variables and ask yourself. I mean, you have to kind of play some what-if scenarios. Is that, look, I know because of interest rates, it's going to allow me to have a lot more purchasing power. I might be overpaying for this house, but with this house going to lose 15%, 20%, 25%. And then you look at this and you say, wow, even if I get it wrong on the perfect purchase price, there's a 50% monthly carry cost difference between the two different interest rates. That can play some crazy tricks on your brain. And that's why the longer you have, Bo, I'm echoing what Bo just said, the longer you have, the more grace you get in this decision making. And that's the part I worry about the people, because it's pretty common. People change careers a lot more than they have historically. I just don't want you to be in a community for a short period of time. Real estate market prices fall down because interest rates go up,
and then
you're in a bad situation. You can't make those career choices. You can't make the financial choices because you just didn't get it right on this big financial decision.
Okay, so housing is obviously a big decision, right? Well, the second largest decision that a lot of us make, and I think everyone has to make this at some point most likely, is vehicles, because inflation also impacts the things that we use every day, the things that get us from point A to point B, that take us from our house to our work and allow us to carry out our life. They have been infected substantially by this inflationary environment that we've been in, amongst other outside variables.
This chart that we had Daniel build for us is truly amazing, because it shows, look, a used car. I mean, if you look in 2015, we had some unique things going on. I believe that was the pigs going on back then with some of the debt crisis over in Europe. So you saw a spike in used car prices where we got around $23,000. But then steadily it's been falling to where in 2020, when the pandemic started, you can see we were just above $20,000. We actually had a pretty, right above $20,000, or around $21,000, somewhere in that range. But then we've been a straight up hockey stick to where when we did this show, I mean, this was last year sometime.
June 30th of last year.
June 30th last year. The number was around 26,000. And you're like, whoa, trees don't grow to heaven. Used cars, be careful. These things typically depreciate like a rock. This has got to be a unique time. Imagine our shock that the fact that now, here we are in 2022, it's over $30,000 on this index. That's crazy, guys. And this is what is, you need to be so careful. I think that this is something that is a danger. Real estate, look, I do think there's an element of scarcity with real estate. You always hear, unless you live in an area where there's a volcano in the backyard, you're just not getting a lot more land. But eventually with vehicles, because right now, prices are going crazy because of several things. And it is tied into scarcity once again, and the fact that it's harder to get new cars because there's microchip issues, there's supply chain with other parts. It is just the turnaround time on the new cars has been slower. So the direct beneficiaries has been used car prices. And then you got inflation that's pushing on that just in general on the value of a dollar. You can see how this could get just create essentially like dry tinder catching on fire and flaming up. And now you've got to figure out, what do I do? How do I navigate this?
Well, I think that's the question a lot of people are asking. Okay, I have to make some sort of vehicle decision. How do I do it right? How do I approach this well? How do I think through this in a prudent manner? And so we thought there's kind of like this if-then sort of process that you can go through. If your current car is reliable and it's working and it's paid off, you might not decide that you want to change right now. I mean, again, if you're thinking about like buying low and selling high, and we know that right now automobiles, both on the new end as well as the used end, are much more expensive. Maybe now is not the best time to buy. I mean, Brian, me and you talk about this all the time. I have a paid off car that's fine. It's not super snazzy. It's not super fancy. I'd love to go buy like an awesome truck for no reason. Then it just looks like it's a cool truck. But I'm probably not going to right now because I don't have to, and prices don't give me a really good, compelling reason to go do that. So I think if you're someone who can postpone making that purchasing decision, you should really think long and hard about doing that.
Well, I always like to play the other side of the coin. If I buy right now, how could this go bad? Where's the true dangers? Remember, human nature, when we see scarcity or we see an opportunity to go, if I go make some of this, I can maybe make some money off of it. So all these microchips and all this stuff will catch up.
It will. That's
All
right.
the supply
This will
chain
revert.
issues will catch up. So all of a sudden you're going to have a huge, because you see these pictures, and we could have had Daniel put it where there's like racetracks, parking lots, and other things just full of new cars waiting for microchips. When those vehicles start hitting the market,
There's going to be some opportunity.
there's going to be
I think.
and guess what? All those people who were waiting on that new F-150 or whatever car or truck that you're thinking about, maybe they bought a used car. They're going to dump that on the market because they're trying to catch up on these new cars. You're going to see a glut of vehicles, and we'll get back to more historical norms. And then I'm worried, I truly am worried about people who are running up and using huge amortization length, meaning they're going 6 years, 7 years, 8 years on vehicles. You might get left holding the bag on vehicles, so I'd be very careful because, no matter how long you own the car, more than likely, now I know there's a troll out there who's going to bring up a 67 Camaro or a Mustang or something, but typically cars don't appreciate when you get left holding the bag, you just get left holding the bag. Well, at least with housing, if you make a mistake, if you live in it long enough, more than likely there's a recovery period there because the market does have appreciation built into it. Be very, very careful with vehicles. Now, Bo, there is one thing, and you took advantage of this.
Sure.
I mentioned earlier, sometimes having time or flexibility might turn out to be an opportunity. Once again, scarcity is the driving factor of a lot of this inflation, is that people need cars yesterday.
That's
so
right.
it's not uncommon. I have a neighbor, beautiful car, but the reason they ended up with this car is they wanted a new car. They rode by, and the dealership had one of the tractor trailers there was unloading. They're like,
I gotta get it.
cars are
I gotta
hard to
get it."
get right now. I see the tractor trailer. I'm going to pull over. I'm going to just say, hey, I'll take that one. I want that one right there because I need a car. That scarcity, that desire to buy no matter what the price is creating this. What can you do to take out that, hey, I've got to have it right now?
Yeah, I think one of the big things you can do is recognize, are there some type of distortions in the market? Or is there some sort of arbitrage that you specifically might be able to take advantage of? Now, this is a hot take. Conventional wisdom says I should always buy a used car, always let someone else pay the depreciation, always buy a 2 to 3 year old used car. Well, there's a chance that right now, actually buying a new car might be a better deal, a better value, a better opportunity than buying a used car. So you have to be willing to stray away from the conventional wisdom. Another thing that I think is really, really interesting is when we went to buy, not our last car, but the one previous, prices for that specific vehicle were insane in this area where we live. So what we did is we started looking at some dealerships kind of off the beaten path, a state away, and kind of some very remote towns,
Yeah,
right?
I mean, you can give them because I just love saying Boaz, Alabama.
In Boaz, Alabama. So I called the dealership and said, hey, I'm looking for this specific car. Do you have? He's like, I've got some coming on the truck. And they were offering it for like $7,000-8,000 less than what that same car was selling for here. So we were able to capitalize on that. Well, then we had to end up replacing another car. And they said, hey, we have some, but they're not perfect in this. If you want one, you can go and commit, but it's going to be like 4 months before you get it. And we said, okay, that's fine. We have cars that are running. We don't have to have it right now. We made that car decision before we had to make the car decision. So because we were flexible in our timing, we may not have gotten a great deal, but we did not overpay, and we were able to get the car that we wanted for a reasonable price, maybe not a great price, because I don't know that there are great prices to be had right now, but we were able to actually get it as opposed to having to make some like knee-jerk reaction decision to try to get a car right now today.
Yeah, because that's what I recalled you look, and I like picking on you because y'all have a minivan now.
Yep, that was
but,
it.
you
It was
know,
a
when you
minivan.
buy a minivan, you ordered a minivan, so that way you're not waiting to ride by the dealership and just hope and pray that there's a tractor trailer that's delivering so 6 people can be bidding on that one vehicle. You calmly went to the dealership and said, hey, I need this type of vehicle. Can we order? Can we come to an agreement on price? I'll wait.
and it worked out just fine.
And look, and if your local dealership, because we know in Nashville, there's people that have so much money, they're just dumb. I mean, I don't know how else to say it, because we live in that type of market. I had this, pre-inflation, I had the same problem with my wife's car, so I had to go to Huntsville, Alabama. I'm noticing a trend here.
Yeah, Alabama might be the place to buy a car.
You can reach out to other dealerships. Maybe your local white-hot market would say, I'm not going to take that space for that car that I might have a feeding frenzy on. But I bet if you look a few towns over that maybe is not in a metropolitan city or something like that, there might be a few more opportunities, because they're going to look at you as one more car that they can close out with the manufacturer for bonuses and other things. So take advantage of that flexibility. Bo, we talked about housing. We've talked about vehicles. How do you make decisions when it comes to your investments in your portfolio?
Yeah, I think it's interesting. Housing, we say, is one of the biggest purchases that you make, and then vehicles are one of the most often big purchases you make. Well, your army of dollar bills may be like one of the most important financial decisions that you make over your lifetime. So if you're thinking about inflation and how it affects these big decisions, your portfolio has to be one of those. And so what I'm worried about, or what I'm curious about, or one of the things that I think might be happening is, earlier on we said, hey, a great hedge for inflation, a great thing that performs well relative to inflation over the long term, or at least has historically, are equities, are mutual funds, ETFs, stocks, things on the risk on side of the portfolio. So you may be hearing this and say, oh man, you know what I'm going to do? Inflation's coming. I'm just going to load up. I'm going to go buy 100% of fill in the blank, S&P 500, individual stock, whatever, as a means of trying to capitalize on not letting inflation catch you. Well, the thing is, we don't know what the market's going to do. We don't know what the market's going to do over the next year, over the next 3 years, 5 years. We have a reasonable amount of confidence it's going to go up over the long term, but we don't know what it's going to do over the short term. So I would be very careful as it relates to my portfolio construction and my portfolio decision making to make drastic decisions on the risk side of my portfolio right now based on the short term, or even based on volatility we may be seeing. This year started off a little rocky. I would argue that if you are, I'm going to make up a number here, if you're an 80-20 portfolio, ending last year, which was a fantastic year for the financial markets, and then all of a sudden this year the market gets a little volatile, I don't know that it makes sense for you to go to 100% zero portfolio. I don't think that's the way that you ought to approach portfolio construction. You should have an allocation that really makes sense for your overall circumstance, both when the market's doing great, when the market's not doing great, and also when you have no idea what the market is doing, because your portfolio should be based on your specific risk tolerance, risk capacity, time horizon, unique needs, unique constraints.
Yeah, I'll summarize, because you covered a lot of ground there. Growth assets. My biggest thing is, especially for young folks, don't let the news media or the fear that we're in this inflationary period, because our most recent Q&A, somebody had asked us, isn't stock investing just gambling? And it doesn't help when we are going through such a period of volatility, because we've started off 2022 with a down market, that I think a lot of young people might just say, I'm going to sit this out.
Sure.
So risk on. I want you just to always be buying. I want you to be putting your money to work, create an automated wealth building process. So that's the part where I'm worried about people being scared off from investing. Let me pivot over to the other unique thing that happens during inflationary periods, because I've fallen prey to this, is what about people who need to have conservative assets, meaning they're risk-off type assets? That's your cash reserves. That's your, the things where you might need this money if there's an emergency, or if you're retired, you might need this money to live off of. Interest rates are so low right now that they've squeezed out your ability to make money.
That's right.
So a lot of people are feeling like they have to go further on the risk spectrum. They have to take a little more risk to get that growth or get that return. And that seems great when you go through a year like 2021 where you're rewarded. But I do worry there's a value to what those emergency reserves and that money's doing, because here's where I've seen traps. A lot of people, because like I said, real estate is booming right now. So a lot of you probably do have 6 figures of equity in your home on paper. And it's not hard for you to go to your local bank or online and they're saying, hey, Open up a home equity line. You can get a checkbook. You can get a credit card. It feels very
use that equity.
Deja vu to what got us into the financial collapse of the 2008 to 2010. And a lot of people are feeling very comfortable. I see it on Twitter. I see it where people I respect and some smart people. I even see CPAs out there saying, I don't need cash reserves. I'm letting all my money work because I've got this house. I've got access. And I'm like, remember, bad news comes. I mean, it's not an introvert. It definitely is not an introvert because you will see market volatility hanging out with job losses. You'll see it with real estate collapses. It all happens at the same time. They're not usually independent of each other. So I always tell people cash reserves. Make sure you have that emergency reserves there to cover you through the bad times. And then also, I worry about my retirees that are worried about their rate of return and the risk. And then you've got to make sure that any money you need in the next 3 years, especially if you're pulling off, you have a safe withdrawal rate, make sure that money's somewhat liquid, because if it's not, I know bonds are so unsexy right now because interest rates are so low, but it sure is nice that you can pull off without having to sell assets that are down maybe 25, 30% in a downturn. Pay attention to those things. Definitely investing is impacted by inflation. It's impacted by interest rates. You've got to bring this all together. And Bo, that's probably a perfect setup to say, a lot of you are probably successful enough. You might need a co-pilot.
That's right. You know, one of the things we love doing here is loading you up with as much free information as we can. We want to teach you how to make great financial decisions and how to take those financial decisions to build your army of dollar bills so that you can reach financial independence. We do that through the show. We do it through the blog, FYI by FTE. We do it through our resource page, moneyguy.com/resources. We do it through our courses at learn.moneyguy.com. We try to provide all of these tools available, but you may reach a stage and say, man, I don't know, the gravity of my decisions is just too big. The numbers have gotten so big, I'm not comfortable doing it on my own. Or maybe I don't know what I don't know. My tax return used to be a 2-pager. Now it's a 200-pager. I don't even know what I'm doing anymore. I don't understand how all the pieces fit together. Or maybe you're just in that stage of life where you're busy. You've got kids pulling you in one direction and work pulling you in another direction. And you have commitment socially. And you have all these different things happening. And somehow your financial life just keeps getting put on the back burner. If you're in one of those three places, or perhaps you're in all of those three, or some combination of those three, now might not be a horrible time to think about taking the relationship to the next level.
Well, I think we've been hiring. I mean, I'm so excited that we've got 3 yeses in the last week. And by the way, if you haven't checked out our careers section of our website, please go do it, because I don't think this is ending. I mean, we're going to continue to grow the Money Guy team. But when we share, you know, how many clients come from the Money Guy show, and I'm like, look, it is the abundance cycle on display, and the fact that we really do mean it. I want you, if you're brand new to this concept, come take all the free advice. Come take the free information. If you go to moneyguy.com/resources, we really do have tons of free stuff there. We also have at learn.moneyguy.com, we have streamlined courses and tools to also help you accelerate that process. We do that, and then there will come a point, all this free loving on and giving you all this advice, you will need all the things that Bo said, and that's where we do have wealth managers. We work with clients all across the country. Take advantage of it. We've been doing this since 2006. You can imagine we've been investing in our audience and our family, our Money Guy family, for over a decade. The dividends are there. I'm going to keep doing it. So, you know, don't feel any pressure. If you're not ready, it's okay. Just keep hanging out. We know if we keep sharing great information, you too will be the best version of yourself financially. And that's what I need to keep us energized, to keep creating content. I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team, out.